Let's talk about Shoppers Stop. This particular company posted some really strong set of second quarter numbers. Their, in fact, numbers look really strong, but the stock actually tagged on the day. On Wednesday, the numbers came out, and on 5th of this month, the numbers came out, and the stock tanked by almost 5%. Their net profit was up about 60% in the second quarter at 15.9 crore rupees versus 9.91 crore rupees on a year-on-year basis. When we asked the management of Shoppers Stop about these very strong numbers posted by the company, but the street did not really, take it well. Street was not very happy with the numbers posted. So this is what Mr. Govind, a customer care associate and managing director of Shoppers Stop, had to say.
I can't comment on what is the street's expectation and the drop in price. I would say I think the street hasn't understood the business because if you turn around the format, which is Hypercity, for the first time into company EBITDA positive, which in India not many formats of that kind are running towards positive. I don't know what to say on that. So I think the street hasn't yet understood the numbers. I think once they understand the numbers, they should react much more positively. I would say a good set of numbers in the department store as well, because 11% like-to-like growth in a market which is surrounded by a lot of discounting all around the place definitely is pretty good. And along with that, we also saw a good margin growth of 50 basis points in the department store category, which has led to the high growth in both EBITDA and PAT.
Talking about your like-to-like growth, that was, about 11%. Did you expect it to be slightly better, or did you face any kind of competition from the e-commerce space, especially in the festival season? And is that what led to this little lower growth than what the street was expecting?
I would say there would be some part of impact happening, maybe 1% or 2% impact, but typically the online assortment is very different than the physical store retail that we are doing. So for example, when you look at it, majority of sale for online, maybe 40% or 45% comes from electronics category, mobiles category, which we really don't retail in the department store. Same way in a Hypercity market where a lot of food, 65% is food for us. There are very few food online players, although yes, there are catchment related players, some in Mumbai, some in Bangalore for example, but I don't still see big impact coming out of that. But yes, the customers would always remain confused whether are they getting the right deal, are they getting the right merchandise at all. So I would always say that to the customers that they should go back and check the physical stores and check the online assortment. What they will realize is the latest fashion, the latest style, the latest trend is available in the physical store today, and in the online sites of the physical store, they are not available on a discount at all.
So what has been the impact of this entire e-commerce in the festive season? What kind of pressures are you facing?
Globally, if you look at it, online is a big channel, whether it is US or whether it is Europe. And US market, it's already contributing between 7 to 8%. European market, it's already at about 10% of share. The Chinese market has actually shown much higher share of online market. But typically in any one of these markets, discounting is not the parameter by which sales are being driven. It is assortment, it is convenience that is driving it. And yes, it is very possible that customers may walk into my store, check out the merchandise and may go home and order from my online site. I am very happy with that kind of a situation because it only multiplies my sale. So if the same merchandise is not available at a discount on any other site, I think we will get the fruits of all the pain that we are putting in both in the physical store and on the online play. So I believe over the next 3, 4, 5 quarters, this pain will settle down and people will come back to normal business metrics, because at the end of the day, any retailer or any business tries to satisfy the customer while trying to make money so that they can invest more to satisfy the customer more and bring in more excitement, more convenience to customers, more assortment to the customers and more experience to the customers.
What about your margins? What were they like in the second quarter and what's the outlook ahead?
So we have seen a 50 basis point growth in the gross margin level. We also seen a positive momentum in the EBITDA margin. That has also grown pretty well. And if you recollect, our objective has been to move towards the 8% EBITDA over the next 24-month period in the department store category and to hit a PAT positive in the Hypercity category. So we are very much on track of for achieving both these numbers, and we believe that the kind of steps that the government is taking today should revive the economy better, should revive the GDP growth rate better, and we should start seeing better growth rates as far as like-to-like numbers are concerned in the next financial year, let's say by Q2 onwards.
All right. Talking about Hypercity now, the losses have been narrowing, and also, break-even has come in the second quarter. What are the plans ahead to make it profitable going ahead?
Sure. So what we had said was this financial year, which is 14-15 end, we want to hit company EBITDA positive, and in the next financial year, 15-16, achieve PAT positive. So in order to hit the company EBITDA positive, we had taken 3 big steps. One is right sizing of the stores. That does seem to be working because our sales, like-to-like sales on square feet have gone up by 14%. And because of the reduction of space, we also seen OPEX dropping, and OPEX drop is pretty large at more than 300 basis points. We also seen the right mix of assortment, which is fashion going up. That is also working. Fashion is now above 14%, and that has also driven margins by more than 70 basis points. So as a result, what we are seeing is the swing in the EBITDA, company EBITDA level, which was minus 12 crore last year, same quarter, has gone to a positive of 20 lakh. So end of the year, definitely we want to achieve a company EBITDA positive for the whole financial year. Next year, we have to hit PAT positive, and for that, we'll have to really rework on 2 more lines, which is depreciation and second is interest. So we believe next year, with the cash flows coming in on account of various areas that we are working on, and depreciation write-offs going away, we should be able to bring both these under control, and they will drop by almost 300 to 400 basis points, which really means that we have to achieve a EBITDA of about 4% currently, which is running at 0.1 or 0.2, which looks feasible right now.
How much is the debt right now, Mr. Govind?
Currently in Hyper, we are at about 160 crore of debt.
And how are you planning to reduce the debt?
So basically next year we believe that the cash flows should start improving. Sorry, the number is actually 206 crore debt. The cash flows that we'll get through the property options that we have should help us over the next 24 months time to reduce it at least by 60 to 70%.
You've also added a number of stores. What are your plans going ahead? What is the capex for the rest of the year?
Sure, we are targeting to open 3 more stores. So about 40 crore plus of capex is targeted for the second half in the department store category. In Hyper, we are targeting to open one more store in the balance period. So that would be again another 10 to 12 crore of capex. So overall, we see about 40 to 45 crore capex going in the second half of the year.
So that was the management at Shoppers Stop giving us more details of the earnings posted in the second quarter. They're looking to add more stores, and the capex will be around 40 crore rupees.